Have you ever been in a trade and you get stopped out for a loss only to have the market come back around and it would have filled your profit? Whether that be a minute later or 10 minutes later or several hours later or even a day or two or three later. I'm going to show you something that I learned a long time ago that if you do this, if you actually take the time to do this, should help you remove 90%, if not more, of your losing trades. And I know there's a percentage of you that are skeptical, which I would expect every single one of you watching this would be skeptical. But I think you'll be surprised if you actually do this exercise. I think you'll be blown away. Now, before I begin, I just want to cover a couple of things really quick because I want to help you understand the mindset that is absolutely required to pull out the kind of money you only hear rumors about. So first of all, you need to understand that someone could be long and another person could be short, and both traders can win their trade. Now you might think, how is that possible? Well, you have to realize that before you criticize someone else's strategy or you place doubt on any particular strategy, you have to realize that each individual person, and it doesn't matter if it's a business professional that trades part-time and maybe they make a few trades a week, and it doesn't matter if it's a fund manager and they trade 10 hours a day. Every single person that's involved in the market has a different reason and purpose behind their trades. So one person could be long here and they have a long-term target up here somewhere perhaps, and another person might be short here and they have a much shorter term objective and they're only looking to grab a smaller portion of market movement. Now during this drop here, it's easy for someone who is short to criticize the person that is currently long while they are in their short trade and say, you don't have a clue what you're doing. This market's dropping. Well, they actually do have a clue what they're doing, and they have a completely different perspective, and they probably have a completely different set of tools that they're using to target an exit later down the road. So in both trades, both traders won their positions. Now, the last thing that I want to talk about very briefly is that I'm going to show you an exercise that, like I said a minute ago, if you do this, it will absolutely transform your trading. But it will only transform your trading if you are keeping very meticulous statistics on what you're doing. Look, here's the deal. If you want to get to the point to where you're making hundreds a day, thousands a day, and even tens of thousands a day, then you need to know exactly what you're doing, when you did it, and why. If you don't have that information, quite bluntly, you really have no business being involved in the market, because what's going to happen is you will lose all of your money. All of the traders that I have ever known over the last 25 years of doing this, whether that be my mentors, people that I've learned from, or people that I have trained that do well, every single one of them keeps track of everything that they're doing. If you're going to put on a large trade and you expect to make $10,000 or $20,000 on that trade, you better know exactly what you're doing, and you better know why you're doing it. So what I want to talk about in this video, I want to show you an exercise that will absolutely transform your results if you internalize the objective. So I'm going to walk you through 3 losing trades, and these are just examples. So what you're going to want to do is you're going to want to go back 2 weeks, at least 2 weeks, maybe 3 weeks. You might be able to go back a week, and I'll show you why. because you need a little bit of market development after your losing trade to have this be effective. And the reason why is because what we're looking for is we're looking for the outcome of these losing trades had we won them. Okay, so let me walk you through this. On my screen, you're going to see three elements. You're going to see a green line. This represents the original profit target. You're going to see the red line, and this represents the stop loss. This is where this particular trade was stopped out for a loss. And you'll see a circle, which is our entry, and a label next to it that either says long or short. So what you want to do to replicate this process is you want to go back and identify, locate your losing trades. Once you have done that, so this circle represents the entry. Okay, so this particular trade, forget about the reason, forget about the strategy, it's completely besides the point. Okay, we just need some very specific information, and it's really easy to get. So here is our entry. This particular trade we are long, and in this trade it was stopped out right at this red line down here. So the red line and the green line, the start of that is at the candle, or if you use bars, wherever you got into that trade. And so what I want you to do is take the green line. The green line represents, this was my intended profit target on this particular trade. You need to know this information. If you don't know this information, it's very important that you know exactly what you are trying to do on every single trade that you make. Otherwise, honestly, you might as well just go down to Vegas and roll the dice at a roulette table, because you'll have probably much better luck. Okay, so what we want to do is we want to start that green line, our original intended profit target, where we got into the trade, and what we want to do is extend it all the way out until price intersects that level. So in this example, price intersected this original intended profit target right here. Okay, and that's where you want to stop the line. So what do we learn about this? Well, we can see that the trade was entered here, we got stopped out here, and it looks like about under an hour, roughly an hour later, had this trade given the market room to move, it would have been a winning trade. Okay, let's look at another example. So here's an example of a short position. Again, we're not talking about strategy. We're not talking about why would somebody get into that trade, because I don't want you to get caught up in thinking, well, that trade's stupid anyways. It's completely besides the point. Okay, so this trade was entered here, stopped out up here, and we draw the line of the original intended profit target down here, all the way out until price intersects this level where we would have been able to take profit. And then let's do one more. This trade is a short entry. So this trade was entered short here. It was stopped out up here. Now this one took a little bit longer. We got to scroll all the way over here, and we can see several hours later, profit was hit right over here. So one of the things that I see traders getting tripped up in is too many people are so quick to immediately put in a stop. So they get into a trade and they either already have a predetermined stop loss, or they immediately put one on once they get into that trade. Well, if we go back to this trade, my question that I would pose to those of you who think this way is this: what is it about that precise moment in time that you got into this trade, so let's just hypothetically say that this was one of your losing trades. What is it about this precise moment in time that says the market is not going to fluctuate by more than your allotted stop loss? In this case, it's here. What is it about right now, this very moment in time, that the market is not going to fluctuate this much and that it's going to run down to hit your profit target? Does that make sense? So in other words, why can't the market do this like you see it doing here on its way down to here? And the reason why this question is so important is because this is exactly how the market moves. We can take anything, stocks, bonds, futures. This happens to be the ES. We can take Forex. We can take anything. What is it about those particular trades that you had in your mind that you believed that the market is at this very moment in time, it is not going to fluctuate? In other words, it's not going to do what it normally does within the bracket that I've set it, and it's going to come down, in this case down, and hit my profit target. What is it about the market? Well, my argument would be that you're trying to contradict the natural movement of the market. This is exactly what the market does. So in our original example, where one trader was long and the other trader was short, this trader that's long knows that the market will do this. It will absolutely have this fluctuation on its way to the objective, the outcome, which is, of course, to take profit. Now, obviously, there is a point at which it's too much. So this is the crux of what we're getting at here. So what this exercise will do, and if you're willing to take the time to do this, and you go back, and I would say spend a week if it takes you a week. Look, if you want to make the kind of money that's available to extract out of these markets, it's very important that you take it as seriously as you possibly are willing to take it, because little things like this literally mean the difference between losing money and making hundreds or thousands or even 5 figures or more day in and day out. So as you go through this exercise, what you will find for yourself is you will find your threshold. Because arbitrary numbers like a 2-point stop, or one of the reasons why I did this example is because I know there's a lot of people that say, well, I'm going to be short here, so I want to put my stop a tick above the previous high in this. There's so many people that do that, and I just want to pound my head on the table every time I hear that, because that is not how the market moves. You have to realize that institutions and professional traders, they know that. And so oftentimes markets fluctuate like this to fish for stops. That's a whole nother subject. But if you go through this exercise, what you will find is you will find your threshold. And what a threshold is, for example, let's say that you go through 50 of these exercises. So you find 50 losing trades, or maybe 25. I would do as many as you possibly can stand, and it's going to take a while, but believe me, it will be worth it. What you will find is you will find your threshold, and there's no magic number, because each individual person is going to be different because of how each of you react to the market. So your threshold is going to be that, for lack of a better term, that bracket, that sweet part of the bat for you, where your entries and where they go negative to where they go positive is going to result in a specific number. So that might be 4 points, it might be 8 points, it might be 2.5 points. I have no idea what it is because every single one of you is different. But what you will find if you do this exercise is you will find what your threshold is. And then what you're able to do is you are able to build an account that matches your threshold. And so as you get better and better and better, that threshold potentially can shrink and you don't need to risk as much. What it will also tell you is that, you know what, the E-minis are a little bit too aggressive for my account size. So for the time being, I'm going to switch to the micros because it requires far less capital. My threshold is something that I can manage much more appropriately. And this will enable me to build my account, first of all, in the positive, and second of all, much quicker than perhaps you could if you were to trade something with higher leverage like the regular E-minis. Now, this same concept applies across all markets. So if you trade Forex, obviously you can make that adjustment in the size of your orders. And that's very simple to do. If you trade stocks, it's going to come down to the number of shares that you're trading. So no matter what you trade, you can apply the same technique to those specific markets. So rewatch this video if you have to. This is probably one of the most valuable things I have ever learned in my 25 years of trading the markets. It reveals so much about yourself, and it not only does that, but it will help you create a structure that you individually can reasonably manage on a day-to-day basis. So regardless of whether or not you use the trading tools I've developed, or if you've developed your own, or if you use tools that are existent elsewhere, it doesn't matter because at the end of the day, all traders that participate in the markets are after one objective, and that is to make money. So what we need to do is create a game that we can consistently win over and over and over again. And this is a little technique that requires time, but it will absolutely transform your outcome. So a little bit of discipline, follow through, do this exercise, and you will be amazed at what you are capable of doing.